Earlier today, the final round spoke with Robert Kaplan, the president of the Federal Reserve Bank of Dallas, to talk about his view on the economy, the labor market, and where he thinks monetary policy might be headed this year. Take a listen. So let's just start with your overview of how you see the economy as we stand right now, final week of March, first quarter coming to an end.
So we thought through much of 2018 that growth in 2019 would be slower. And we started to see some real evidence of slowing in the fall of 2018. And we saw global growth decelerate, we saw financial conditions tighten, and we saw some cyclically sensitive industries like housing start to weaken a little bit. That's continued into 2019. The first quarter numbers are going to look weak, but you got to remember it's a little noisy because of the government shutdown. So I don't want to overdo my judgments based on the first quarter. But our own judgment at the Dallas Fed now, if we grew close to 3% last year, 2.9%, we'll grow something more in the range of a little less than 2% in 2019. So we could still grow at a reasonable rate, but it's going to be lower than 18. The issue right now is there's a lot of downside risks and uncertainties around even that 2% forecast.
Yeah, now I think the most recent discussion in markets that people have become very excited about is the yield curve. Today, as we speak, the 3-month, 10-year, actually back to even par. But last week, for the first time in about a decade, we saw that inversion. Earlier this week, you made some comments to the effect of you'd like to see that for a more extended period of time before you get worked up about it. But in terms of your thoughts on the economy, how much are you looking at the Treasury curve?
I look at the Treasury curve, but I've also cautioned, don't overreact in any moment in time. In that, for example, today's good. The 3 months to 10 years today is flattish. The 2 years to 10 years is upwardly sloping. Let's just see. What I want to see before I'd get concerned about the Treasury curve, and I've been one who said I am concerned about an inversion, but I need to see an inversion with some magnitude and some duration. And right now we don't have either.
You talked about a couple of months ago, 5 or 6 months ago, just talking about getting back to neutral. Right now, as the rate stands at 2.25 to 2.5, do you think that we are at neutral? Because it could be a very challenging process in order to get there.
I'd say we're in the neighborhood. Now, we'll know a little better in hindsight, and also the term neutral and this whole concept is amorphous, it's imprecise, and we know that. But yeah, my sense is that we're in the neighborhood. If we do grow, big if we do grow in a range of 2% this year, that would probably confirm my view that we're in the neighborhood of neutral. If we grow much more slowly, or it turns out the second quarter and beyond is slower, that might tell me something different about where we are versus neutral. But at the moment, I'd say we're in the neighborhood of it.
Now, the last time we spoke about 5 months ago, you described the labor market as the tightest that you'd seen in your lifetime. Any signs that something has changed there in the labor market in terms of how much you have to pay to get quality workers and how employers are reacting to that?
It's probably tighter now from even versus 5 months ago. And so the good news is a number of groups that have been underrepresented have now re-entered the workforce. A good example, women with a high school education or less have disproportionately re-entered the workforce. Those are all good signs. But no, we've got a very tight labor market.
And we're trying to make sense of one of the big uncertainties out there, risks to the economy, is the trade issue between the U.S. and China. Give us an inside look in terms of how the Fed is thinking about this. How important is it for second half growth?
So there's a number, I mentioned, there's a number of uncertainties around a 2% GDP forecast. And you can rattle them off, decelerating European growth, waning fiscal stimulus. Trade's one of those uncertainties. And if it gets resolved, it doesn't mean it's going to create a burst of greater growth, but it could remove an uncertainty that might make a business person more willing to spend on capital expenditures or expand. But right now, the trade uncertainty is I think having some chilling effect on capital spending and other activities by business leaders. So if that could get resolved, it's one less uncertainty that I'm worried about. So why does trade matter? It's very critical to a country like Germany, essential. And Germany is slowing dramatically. It's important to the U.S. It's very important to Texas, but not like it is in Europe, but the fact of the matter is integrated supply chains and logistical arrangements have been critical to helping improve U.S. competitiveness and adding U.S. jobs. And if you put sand in the gears of being able to do that, it just creates another uncertainty for businesses as they manage their business.
And we'll get you out of here on this one. Rest of the year, do you think it'll be appropriate to raise rates again? And do you think that perhaps the next move for the Fed could in fact be to decrease its benchmark interest rate?
What I've been an advocate since for some number of last few months is I don't want to make a judgment on that yet. I want to see how the second quarter unfolds, and then we'll make a judgment as the year goes on. And so for the moment, I think the stance should be flexible and patient. In my dot plot for the year, I put a 0, which is no rate increases. That doesn't mean it's going to turn out that way. I'll gladly reserve the right to change my mind either way, but I'm not ready to make a judgment yet, but I will in the next couple, 3 months.
All right, that was our conversation with Dallas Fed President Robert Kaplan. Brian, he identified his own dot, but boy, he allowed himself the room to do whatever he wants later this year.
And for what it's worth, I mean, almost everyone on the FOMC for the March meeting signaled that there would be no rate hikes in 2019. But I thought what was interesting was his commentary on just the general, U.S. economic growth. His projection for 2019 said it was a little less than 2%. I actually thought that was different language than what we've heard from the Philly Fed president and also the San Francisco Fed president this week. They both said around 2%. So that doesn't necessarily mean that he could be hinting at a rate cut, for example, but it just shows that there's a variability of a perspective on U.S. economic growth for this year.
Yeah, it certainly does. And I also thought what was interesting, I mean, he said a number of things when you asked him about the tight labor market. That was interesting, his thoughts there.
Yeah, I found that interesting because I think some labor market signs have gotten a little bit softer. But
yeah, and he was saying that it's even
Texas,
tighter. And he actually pointed to, what was it, the number of, especially women who were high school educated or less re-entering the labor market. So that was a little bit interesting. And then also just in terms of trade, just because that has been something that we've been talking about so much here. And he was just saying that obviously if that is resolved, it's good news for the economy, but it's not going to be this type of catalyst that will create greater growth. There's a lot of other things that are going on out there, like Europe, what's happening over there, that could also cause a global
And this all folds into this idea of data dependency. The Fed is not going to commit to a rate hike or a rate cut. They're both in the cards. And I think when you hear Kaplan, when he's pressed on the idea of should the next move be a rate cut or a rate increase, he just said, I don't want to make a judgment right now. His projection is for none, but anything could change that. So it really depends on how the developments come in for the next quarter.
And then next week we get jobs report, and then a whole new round of Fed speak, and then everyone can revise their forecast once again. All right, Brian Chung.
Always happens.
Thanks for joining us.
Thanks.